Thanks for clicking. The cause of and solution to Canada's inflation problems is the money supply. This according to a new report coming from the IMF. The report undertakes a large and quantitative approach, looking at 100 cases of inflationary shocks since the 1970s, and seeks to identify why some countries, such as Canada, were unable to tame their inflation rate as fast as others. And while, as we recently covered on this channel, Canada's current experience with inflation was very much due to an increase in the money supply, the report from the IMF says that that could also be the cure. Reducing the amount of money in the economy will eventually reduce price pressures.
I seriously doubt it.
Given that Canada and the US are seeing hints that inflation could be resurging, the release of the report is particularly timely. So what I want to do today is go over the report, taking a look at its findings that countries need to reduce their money supply in order to tame inflation, discuss the Bank of Canada's current efforts to reduce Canada's money supply, and then go over what to look for next. Speaking of next, the end of the month is fast approaching and we're eagerly awaiting the release of September's real estate data from the local boards next week, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. Onto the report. The report analyzes 100 cases of inflationary shock episodes that occurred since the 1970s. That is, cases where inflation increased by more than 2% within a year after fairly stable inflation. The report takes a look at Canada's surging prices in the post-1973 oil shock environment, when inflation increased from 3% to 12% between 1972 and 1974, which, the report says, was a direct result of the first oil shocks. And, very briefly, although the report doesn't pay too much attention to the other factors that could have caused the inflation in the 1970s, I think it's worth noting that we've seen multiple studies showing that inflation would have occurred, though maybe not as bad, even without the oil shocks. This includes a 1978 report from the Department of Finance showing that Canada's money supply had been increasing rapidly in the run-up to the 1973 shocks, concluding that, in the long run, an increase in the money supply will lead to inflation. This notion has also been backed up by other reports coming from the IMF, from former Bank of Canada Governor Stephen Pallaz, and from numerous other studies coming from the Bank of Canada. Yep, the same central bank that said that interest rates would be low until 2023 was fully aware that an increase in the money supply was one of the causes of the Great Inflation in the 1970s.
Why would they lie?
Whoa!
Regardless of the cause, however, the IMF report recalls that in response to the oil shocks in the 70s, the Bank of Canada initially loosened policy aimed at protecting employment and then subsequently tightened. However, the big problem, says the report, is that as inflation appeared to be receding in the mid-70s, going from 12% to 8%, the central bank loosened policy again. And we can see this looking at the bank's rates post-1976, when the prime rate dropped 2 percentage points within the period of a year.
It'll happen.
However, the report calls this a premature celebration and resulted in a resurgence of inflation in the late 1970s and early 1980s. And while some will say that the 1980s inflation was caused by the second oil shocks in 1978 and 79, the data shows that inflation was already starting to re-accelerate upward even before the Iranian Revolution and the resurgence of oil prices. And one of the reasons for the re-acceleration, says the IMF, is the money supply. As, when it looked at all 100 cases in the aggregate, those countries which resolved their inflation, brought their inflation down, saw their money supply decrease by 4% compared to its pre-shock rate, whereas countries that did not resolve their inflation were not able to tame price increases actually increased their money supply by 3%. And we can see this very plainly at work when we look at Canada's money supply and its inflation rate in the 1970s and 1980s. If we look at the growth of Canada's broad money supply in the 1970s, we can see that it was at an elevated rate throughout the decade and then dropped precipitously in the 1980s. And then, unsurprisingly, inflation remained elevated throughout the 70s and then dropped very quickly in the 1980s. And while the numbers and percentages vary from case to case, the key point coming from the IMF is that the money supply has to fall relative to the pre-shock rate, relative to the rate of the money growth prior to the thing that caused the inflation in the first place.
I forget. Why was it?
So, when a country experiences an inflationary shock, if it can reduce its money supply growth relative to the growth that it had prior to the shock, then it will have a much easier time taming inflation. And for us, for our purposes, for predicting what's going to happen with the inflation rate, that's good news. as Canada's money supply growth has been falling and is now well below the pre-shock growth rate. And while that's definitely good news, the bad news, as we'll see, is that if these 100 cases show us anything, is that taming inflation is a long and bumpy ride. In only 60% of all 100 cases of inflation shock did inflation return to its pre-shock level within 5 years. And of that 60%, it took an average of 3 years to return to normal. And that's if the central bank doesn't blink, if the Bank of Canada doesn't prematurely celebrate, which it kind of already did when it entered into its conditional pause at the beginning of the year, which, in its most recent summary of deliberations, the bank appears to be now regretting. And it looks like the IMF concurs with that regret, noting that policymakers should avoid loosening policy settings in response to emerging softer inflation readings, as these often represent premature celebrations and may reverse later.
It's not going to happen again.
So, according to the study looking at 100 cases of inflationary shocks, in order to get inflation back to its pre-shock rate, we need to reduce the money supply. And the central banks, the Bank of Canada, full well know this. They know they need to remove money from the economy in order to get inflation back under control.
Don't you tell me what I know.
You know what you did, pal.
That's why they're raising interest rates, to get the money out of the economy. And, as we've seen, it is working. The Bank of Canada could stop inflation tomorrow if they wanted to, simply by selling off the $267 billion worth of government bonds that they currently have on their books. They could sell a large chunk of those bonds to the banks, which still have $147 billion on deposit at the Bank of Canada that were printed for them back in 2020. If they sold off all those bonds, that would be $270 billion leaving the economy, going into the Bank of Canada's accounts. If $270 billion leave the economy, there won't be a whole lot of money left to be lent out to anyone else. Money supply tanks, all things being equal, inflation drops. But if they did that, the price of those government bonds that were now flooded onto the market would tank, yields would skyrocket, and so would mortgage rates. So the bank is trying to do a slow burn, a slow wean, slowly getting money out of the economy, hoping that it doesn't break too much. When you take too much stimulus, the high is great, but you have to be slowly weaned off thereafter, or you will crash. With that said though, reducing the money supply definitely isn't easy, and it can be a bumpy ride. Ask anyone about that in the 1980s, when inflation was indeed reduced, but we also saw a major recession. With all that said, we will continue to track the Bank of Canada's efforts to reduce the money supply and its effects on inflation on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.